Myth busting time, my favorite topic. Today, we're going to bust the myth of buy and hold. We're going to talk about 4 myths that surround buy and hold investing. And then we're going to talk about why, if you listen to those myths, you could be losing out. So let's get started. Before we get started on the 4 myths, I want to talk about the reasons why I do not believe in buy and hold. Let's take a look at a chart. This is a chart of the Dow Jones Industrial Average, and it goes back to 1900. So what we're looking at here is about 125 years of data. Is that enough for you? I hope it is, because it really does illustrate that buy and hold investors have not always profited just by staying in the market. Let's take a look. Way back in the first 20 odd years, about 20 years or so, on the Dow Jones, you can see that the market was completely flat and yet tons of volatility in that time period. So here's the question I have to ask you. If you invested here, would you have been happy to make no net returns beyond the dividends for the next 20 years? Let's take a look at some more data. Between 1930 and 1940, actually a little bit longer than that, a 15-year period, the Dow put in a high in 1939, did not break that high until 1950. That's more than 15 years, where had you invested in 1939, you'd be net the same place, except for dividends, 15 plus years later. Let me ask you, would you have the patience to sit there for 15 years and make nothing on your money? Now, this is one of my favorites. Between 1965 and 1982, the Dow Jones was trapped at a lid of 1,000. It did not crack 1,000 for 17 years. If you had invested in 65, 1982, you still had the same amount of money except for a little bit of dividends. Boom, the market broke out of that eventually. But the only way you could have made money in any of these periods, whether it was this period, or this period, was, you guessed it, trading. Buy and hold did not work. You would have to have an immense amount of patience to be able to accept these sideways returns. One last sideways period. 1999, the market made a top and then did not break that top after 2 successive 50% plus stock market crashes, one in 2001 and then the second one, 08-09, where the Dow Jones Industrial Average did not break out to a sustainable new high until 2013. Now let's do the math here, guys. That was like 13 years of sideways markets before the market broke out, and we have been in a bull market since 2013, that actual breakout point, that is, since 2013. So that's about 11 years of upside at this point. I'm not going to make any predictions here. What I will say is if you invested in 1999, you went through 2 50% crashes and did not start to make legitimate money as a buy and hold investor until around 2013 and on. Again, most people I know don't have the patience to sit there for 13 years, watch their portfolio literally lose half of its value twice in that 13 years, and just not worry about it. Maybe you're one of those type of people, but I'm not. I try to take advantage of these swings. Let's get to the next myth, which is, well, you can't time the market anyways. Let's find out what market timing really is. Now, if a buy and hold investor said to me, well, you can't time the market, I would ask him or her, what do you mean by market timing to begin with? Because we need to be speaking the same language here. Well, they'll usually tell you that, well, how are you going to pick the bottom and how are you going to pick the top? And there's where I would actually agree with a buy and hold investor. You can't pick the tops and you can't pick the bottoms. But that does not imply that you should sit there like a deer in the headlights and watch your portfolio disintegrate by 20, 30, 40, 50% during a massive bear market. You need to have some structure to get you out. By the way, I offer an online technical analysis trading course that does just that. It's got 35 years of my personal history as a professional portfolio manager and trader in it, showing you how we at Value Trend manage people's accounts so that we move in and out of the major trends of markets, even though we can't spot the exact bottoms and tops. We still call what we do market timing. I encourage you to take the online trading course, and if you don't want to do it yourself, come and talk to us. Now let's take a look at the basics of a system that you can use to identify if the market has a probability of moving into a new downtrend after having been in an uptrend. I'll go way back to the early 1990s. We were in an uptrend, and I call that phase 2. As you can see, there are uptrends, there are topping patterns, there are downtrends, and there are bottoming patterns. We identify those 4 phases, which I label 1, 2, 3, 4. It really doesn't matter whether you want to remember those numbers or just call them up, top, down, and base. I often refer to them as that. Here's how to identify those 4 phases. An uptrend is identified by a successive series of higher highs and higher lows. That uptrend comes to an end when it stops making successive higher highs and higher lows. Often, the market will move into a consolidation pattern. When that consolidation pattern makes a lower high and a lower low, we have the makings of a potential move into a downtrend. That is confirmed, and I will erase a couple of these lines on the screen so you can see better. We confirm that by a lower low and a lower high and a break of the 200-day moving average. Now I'm using a monthly chart here. I'm using a 10-month moving average, but that's pretty close to the 200-day, and that's the way we identify trend changes. So again, here we have a bottom pattern where we've got no more lower highs and lower lows that we were making during this period. In fact, we take out, and I'll erase the line again, we take out the last significant peak, and we moved into an up pattern of higher highs and higher lows. And we also, as you can see here, moved above the 200-day. When both a higher high and a higher low and a break through the 200-day moving average, or 10-month in this case, when that happens, we have the making of a new trend. In this case, it was an uptrend. In this case, it was downtrend. And this kind of thing happens over and over and over in the stock market. So can you time the markets to pick exact peaks and troughs? Well, I can't, but I can definitely identify when the market has made a lower high and a lower low and taken out the 200-day moving average. I wait a few days to make sure that after these 2 occurrences happen, that it's sticking. In other words, that it's legit and it's not just a head fake that may see the market go back up again. But if I do see that it's staying, I start to sell. Do I sell at the top? Heck no. But I do know how to sell so that we preserve the majority of our capital, and Value Trend's track record will show you that we've done just that. Our volatility statistics are extremely low when compared to the market and many other portfolio managers. Myth number 2. If you miss the best trading days, you will miss out on the majority of the returns on the market. This data goes back to 2000 to 2020. I don't have data for the last 4 years, but the American Association of Individual Investors did a survey around 2020, and they came up with this information. And that is that the average return on the S&P 500 over that 20-year period was 10.6%. And by the way, that's very close to the long-term track record of the market, no matter how far back you go. So that was what the market was making, including dividends, about 10.6% if you just bought and held the market. So next thing, if you missed the best 40 days within that 20-year period, you would have only made 3.5%. So now we have an argument from the buy and hold people saying Well, you better not try to time the market because you might miss those 40 best days. So before we get into the probability of market timing so badly that you would miss all 40 of the best days, let's look at the reality of the opposite, which is, well, if we're going to look at missing the best 40 days, what would happen if we missed the worst 40 days? Drum roll, please. If you missed the best 40 days, you only made 3.6%, but if you missed the worst 40 days over that 20-year period, you made 17.6%. Now that is a full 7% annualized per year better return than the S&P 500. So what are the odds of missing the worst or the best days through an active trading system? I would suggest the odds are low. You would have to have an almost clairvoyant ability to make bad decisions to miss the best days. I would almost say the same thing about the worst days. You would have to have an almost clairvoyant ability to miss all of the worst days of the market. A more fair comparison statistically is to look at what happened if we missed all of the worst days and all of the best days. And here we have a study done by Irrelevant Investor. Now this was over roughly the same period of time, 2000 to 2019, but it only looked at the worst 25 days versus the best 25 days versus the market. Okay, but it's statistically going to show you the relevance of missing these days and the consequences or benefits of doing so. So here we have at the bottom the red period. Well, like we saw, it was only about a 3.5% return. Not very good, right? If we just invested in the market, which is this black line, like we just saw, you made about 10.5%. Okay? Pretty good return. In fact, in this scale, it's not based on a percentage. So you put $1 in the market on the S&P 500, you ended up with about $13 by the end of 2019. Now let's take a look at the gray line, which is if you missed both the best and worst days, and you still ended up ahead of the S&P 500. So what this tells you, if you know anything about mathematics, is that the value of missing the worst days far exceeds the penalty for missing the best days. And this is shown by missing them both on the gray line, and yet you still made more than the market. So it's much more important to miss the worst days, or at least some of them, than to miss the best days. Myth number 3. I have literally written articles on this for magazines and newspapers over the years because it's been a myth that's been propagated for much of my career. Warren Buffett, literally known as the greatest investor of all time. Warren Buffett has a reputation of buying and holding stocks and never selling them. Well, that's an absolute myth. It's absolutely true that many of the stocks, like Coca-Cola, he has held for the long term. So part of the structure behind Berkshire Hathaway has been to buy and hold some stocks. But is buy and hold Warren Buffett's sole key structural part of his process? Absolutely not. In fact, right now, as I record this, Berkshire Hathaway has raised a whopping 25% cash. Is that a buy and hold investor? A structure that puts a quarter of the portfolio into cash? Let's take a look at some examples. Warren Buffett trades over the years. In 2020, you might remember, market correction, he ended up selling Goldman Sachs and buying gold. Let's take a look at another example in 2020. He decided that airline stocks were not going to do well because of COVID. Warren Buffett, just this year, has been selling his large positions in Apple and Bank of America. He has raised, as I mentioned a minute ago, 25% cash in Berkshire Hathaway. So the myth of Warren Buffett accumulating his wealth strictly through a buy and hold process is absolute hogwash. In fact, one last story is I remember about 10 years ago where he was trading in and out of silver fairly aggressively. So let's get rid of that myth for once and for all. So let's talk about the tax burden on buy and hold investing versus trading and taking incremental gains. Whenever we sell a position, we take a capital gain, which is at this point in Canada, 67% inclusive on your income tax return. So let's use an example of an investor with $100,000. And the investor puts the money into a stock that grows to $200,000 in 10 years. I'm using simple numbers. All right. Now, even the most mathematically challenged of us know that is a capital gain of $100,000. That means that if one were to buy and hold, and then in year 10, sell the stock, you would be claiming a $67,000 income on your income tax return. Well, that means that you've just increased your tax bracket by $67,000. I'm not a licensed tax advisor and I can't give tax advice, but what I can say is that if this is what you did, you would definitely be putting yourself into a higher tax bracket. True, there are stages of your current personal income and how much capital gains they're going to attribute to your return, but let's assume you are already in the highest tax bracket, so it will be a 67% inclusive rate, just to keep things simple. Now, if instead of taking the $100,000 gain down the road, you incrementally took $10,000 a year by trading, then you would have only claimed $6,700 per year. That puts you into a much smaller tax burden in every given year rather than the full $67,000 that you would have had to claim at some point down the road. One of the other points to understand about taking incremental gains versus one large gain down the road is that tax rates never go down. Please tell me, when have tax rates gone down? Case in point, here in Canada, this year, the capital gain rate went from 50% inclusive to 67% inclusive for people in the highest tax bracket. That is a massive increase, and it's never going to get better. No matter what politician says what, it's very difficult to lower taxes after they've raised them. So, by taking your incremental gains sooner rather than later, it is highly likely that you're going to end up paying lesser taxes for all of the reasons I've just mentioned. To finish up, the myth of buy and hold. Can you time the markets? Well, you can't find bottoms and tops consistently, but you can definitely use a process and a system to get you in and out in a logical manner so you don't have to experience huge drawdowns on your portfolio. That much I've proven through my career. Number two, missing the best days will crush the returns. Well, funny enough, missing the worst days helps your returns at a far greater level than missing the best days. And unless you're magnificently incompetent at trading, you'll probably do better by missing some of those worst days. Number three, Warren Buffett made his fortune through buy and hold investing. Well, that's a lark. Myth number four, trading causes a tax burden. Well, we know that it's better to pay your taxes now than later, and especially better to take a smaller gain now than a huge gain down the road. Thanks for watching. We'll be bringing a lot more content to you over the coming year, and I do wish everybody a happy new year in 2025.